real estate enthusiasts. Okay, so I really wanted to touch on your yield returns and your returns in general on an investment property. So I don't necessarily want to say right, wrong, or indifferent, but I really want to kind of open your guys' eyes up to different opportunities. So right now there are so many people teaching you about value add opportunities. And yes, when you buy a business that's underperforming and you can go in and you can ramp it up and you have the potential to now make so much more money because you went in and you did upgrades, you pushed rent, you did all these pieces to it. And so now you're able to get like this really big spread. And your yield is higher, return is higher, and numbers are looking really, really awesome. But to get from here to here, that is up to you. So a lot of investors, they have a process, they have a lot of capital reserve, they have experience, and so they know the time it takes, what it takes, and they're prepared for surprises, etc. And so value-add opportunities are a great opportunity for them. But when you're looking at your portfolio, I also want to add in some value-add opportunities sometimes are located in areas that might not have the highest quality of tenants, or they're a property that you created a lot of value in, but you had to do a lot of upkeep to get it there, and it's just an older property, and so now you have to do a capex for years and years and years and years and years to just kind of sustain and maintain it that way. And so when you look at your whole return over time, you realize it's not that high. Just because of the upkeep and the late tenants, and your additional time and management that took to take over this property. I'm not saying that's exactly the situation, but I just want you to kind of get an overview look of really what to look at. So sometimes, actually all the time, if you were able to go in as an investor and you were able to capture income producing stabilized assets, over time, your return would be so much higher if you were able to do frequency. So that's where other people's money comes in, and being able to do creative financing, because if you are able to purchase stabilized income producing assets frequently, your yields and your returns every year would be so much higher than buying one or two value add properties a year. Because value add opportunities, they do take a lot of time. They take a lot of resources, they take a lot of people, because you need a lot more money, a lot more reserves, and a lot more people going in and fixing them up and everything like that. And so most investors can only do one or two a year, depending on the size of property. I'm talking about commercial properties here. Most of what I'm relating to is always commercial properties. So if you were going to go in and do a storage facility or a multifamily property or an RV park that was underperforming and you had to create value add to that property, then it takes a lot of time. It takes a lot of time to get from where it's at to where you want it to be, to where you're really going to capture that huge return. And so instead, if you purchased at a higher dollar a stabilized asset that was performing, and because it's performing, you're able to just take over, get everything switched over, have your system in play, and then you were able to buy another one, buy another one, buy another one. All of a sudden in that year, you're able to make more than you could in the value add opportunity, and it's taking less of your time. You're having more income producing property quicker, because you were making money day one, and your net worth is going to be so much higher, because now you were able to purchase 5 or 6 properties instead of 1 or 2, and you bought them at a higher value, and so the value of these properties are higher than your value add opportunities. So like I said, value add opportunities have so much potential. And if that is your business model and that is what you can handle, time, money, resources, experience, etc., it's an amazing opportunity, because the limit is really high. It's whatever you can do and put into it and have your experience into it. It's just a great opportunity. But I really wanted to point out the other investment opportunity, because so many people pitch value add right now. And for newer investors or for, commercial investing, it takes a lot of money. So if you don't have that experience or if you don't have that capital reserve, take a different approach, take a different strategy, and realize that buying stabilized assets, income producing day one, and being able to cycle that more frequently because they're stabilized, you're getting returns, you're able to pay people back, you can have less people in the deal, less resources, less of your time, less management. So you're able to actually flip that quicker. Your returns over that year are going to be so much more, and your net worth is going to be so much more. And a lot of times your stress and your headache because stabilized assets, a lot of times they're newer properties, and so they have less maintenance. They're in nicer areas, so you have more positive tenants. So just a lot of things to consider when you're going in to purchase a property. So I like to talk about the fact that real estate is such an awesome opportunity, but not all real estate is created equal. And so I like to point out where the inequalities are and what to look for to make sure it aligns with you and your goals and kind of what you're working on. So subscribe below, comment below. I love to hear what you guys are talking about. I'm a commercial real estate investor, so I primarily talk about commercial real estate. And keep watching. I focus on terms and other tactics and strategies as well. And again, comment, subscribe below, and see you in the next video.